about what's been happening with interest rates. What are the changes that have happened, and why do you think those are happening?
Yeah, so interest rates still headed up. Basically, the Fed has came out and said, hey, we're going to do anything it takes in order to curb this inflation.
So where have interest rates been, and where are they currently, and where do you really see them going?
So interest rates, where they've been, so all the way back in December, 2.8, 2.75. 1 month ago, 6.3-ish. And then today, anywhere from 6.75 to 7%.
That seems like a pretty dramatic increase.
Pretty dramatic. It's the third highest increase since, was it 1940, I believe. So they've gone up the quickest.
So you see in the foreseeable future, this is going to continue to happen.
As long as the Fed thinks that inflation is an issue, yes, they're going to keep doing whatever it takes in order to slow us down. What goes up comes down. So eventually at some point, we think they're going to come down, but not exactly clear. It's kind of day by day right now.
It sounds like that's a pretty big increase. So that has to be affecting your clients. So what are you seeing on your end as far as your clientele, people coming to you looking for mortgages, your current clients? How are they adjusting their budget? What's the impact been?
So it's not a huge surprise when I tell them kind of what the rate is.
Yeah.
What I've been kind of working with them though is let's look at payment first, because really it doesn't matter psychologically what the interest rate is. It's can you afford the payment? So let's talk about the payment. Let's see what fits into your budget, and then let's go from there.
And so from my end, I'm seeing clients having to kind of adjust their budget, and not by any dramatic amounts, but the increases are affecting people. And I feel like there's no way to get around that. It's just happening. And, I'm seeing that buyers are getting away with more creative offers, which just wasn't happening before. So I feel like they're taking a hit on the front end with interest rates getting more expensive. But on the other end, I see that more opportunities are becoming available for buyers at the same time. And you brought up, what it comes down to is their monthly payment. Are you dealing with clients that are saying, well, we want to see if prices come down, or, we want to figure out a little bit more where this is headed before making a purchase? Are you seeing that at all? And what do you think that actually translates to if there were a change in purchase price versus a change in interest rates?
Yeah, so a couple things there. So yes, people are coming in, readjusting their budget down because the payments are going up. So they may have to come down as far as their purchase price goes. But that shouldn't, it's a whole category of people, meaning everybody who's in that $1 million price point have now came down to the $900,000 price point, or $925,000 or something like that. Waiting versus should I buy now is also another conversation. Right. Are you hearing that conversation from your point of view too?
I think it's a valid question, right? When we consider the most recent dramatic change in pricing, that was, what everybody relates to is the 2008, 2009 crash. We're clearly nowhere near this. This is an economic base. We're part of this cycle of inflation and how to combat that. So any type of change in pricing, if we're going to see it in our particular area, I think it's going to be pretty gradual. But what I try to explain to people is what matters is your bottom line, right? What matters is your monthly payment in terms of affordability. And so I would love if we could touch on that about, okay, if we're going to have a change in a percentage of purchase price, which not necessarily we will, but let's go ahead and say that would happen. What does that actually mean to your monthly payment if interest rates continue to go up, which the Fed says that they are going to do?
So how about I share a slide with you real quick? Okay. So what I did is a little comparison here, and I started off with a 1.3 purchase at today's interest rates at 6.5%. So basically, principal, interest, taxes, insurance, everything comes out to about $8,007 per month. So this is today's scenario.
Right.
Let's just say interest rates go up, and let's say prices go down by a little bit. So it drops from the 1.3 down to the 1.25. So scenario, prices drop by 50,000. Interest rates go up, and let's say prices go down by a little bit. 7% interest rate down to the 1.25. So scenario, prices drop by 50,000. We're at 8205 per month if prices did come down a little bit, but interest rates went up.
Okay.
So I kind of like the first situation better at lower
Yeah.
interest rates today. Let's
Yeah.
take a little bit more dramatic. Let's say prices fall by $100,000 in this scenario, but then prices interest rate goes up to 7.25, which would mean $8,048 per month. So still puts you at about the same payment as today's interest rate at the 1.3 versus if prices go down by about 10% and rates go up to the 7.25. So to me, it's like, I don't know if I would wait. I don't think I would wait for prices to go down because you're almost in the same situation as today. And we know interest rates are going up. The Fed has been clear on that, that's where they're headed to.
Right. Right. Wow, that's really, really clear and makes a lot of sense.
Are you seeing that buyers can actually have those contingencies in place these days?
I am seeing absolutely, yeah. And so if this were 5 months ago, no, no way. And we would be competing against 15 other offers, and it would just honestly be a lose-lose situation. That was just not a healthy way to buy real estate in my opinion. And the amount of appreciation that we were seeing as well was 20% month over month. These numbers were just absolutely unheard of. But now I'm in contract right now where we have a contingency of sale in place. We have a contingency of finding a replacement property in place. We have, a 17-day physical contingency, 17-day finance and appraisal contingency, when people previously were waving their appraisal contingencies to the wind. And, it was pretty cutthroat. And so, in the state of California, we have these protections built in specifically to protect the buyer for very important reasons. And, 5 months ago, people just weren't having those protections. So I find it really encouraging that we're getting into much healthier transactions, and everybody is honestly coming out on top.
So I've read some of the articles of buyer's remorse right now. Not right now, of previous transactions that have happened where basically they're buying with no contingencies. Now all of a sudden they've been in the house for 4 or 5 months. It needs a new furnace, it needs a new roof, all the things that they waived trying to get into it. And they're just like, oh my gosh, now I have to pay for all this stuff after I finally got into a home. And nowadays, again, like you had said, they don't have to release those contingencies. So it could be a better transaction.
Right. And so, but you got to consider on the flip side of the people that are having the buyer's remorse, were they buying at, 3.25%, where they're saving a bunch of money each month? I mean, there are trade-offs no matter when you jump in the market. I feel like there's always going to be some type of trade-off. It really just comes down to, is this the right house for me? And is it affordable to me? And if both of those things are yes, then there really shouldn't be much of a hesitation. It's all about your affordability and your comfort level. So with this, I just like to show, because I'll do buyer's consultations and they'll say, oh, the market's crashing right now. And I'm like, no, it's not. Let's take a look at the numbers. And so we'll look at these stats from, year over year, we'll look month over month, just to kind of take a look at the different trends, because I feel like there are some indicators here that show a change in the market, but we're not seeing like this huge crash. And if you're getting into the market expecting that, I think you're going to not have a good time, because the numbers just aren't showing that just yet. So you can see here, we really had a spike in March. I mean, median sale price being 1.6, that's pretty outrageous. But you can see that we're not having some dramatic change in price month over month, at least. And then when you take a look here, I like to compare year over year, because I feel like that shows a better trend, because just, annually, month over month, there are good, hotter times to buy, colder times to buy. And so there's kind of like a wave there. So let's look year over year. When you consider August, I mean, interest rates are the highest they've been in a long time. So we would see an impact now on the purchase price, right? Because buyers are having that immediate effect on their ability to buy ultimately. And you can see year over year, we're still up just under 4%. We're still showing appreciation. And so I just really like to outline that to people, that, we're not necessarily going down at this point. There's probably going to be a bit of a give, but like I said, I think it's going to be more gradual than anything else.
Yeah.
And then another indicator that I notice is median days to sell. Previously, oh my gosh, you had to be on it. Properties were selling within a week. And if they lasted 2 weeks, that was only because it was a set offer review date, but that was really rare. And you can see that this is an indicator because it is on an upward swing. 18 days is not a long time to get an accepted offer. So properties are still selling relatively quickly. It's just not that cutthroat situation that we were experiencing before. And then I like to look at the sale price to list price ratio. And this is the lowest that it's been in a long time at 100%. But properties are still selling generally for what they're asking for. And that's why I like to, bring this up to buyers is, hey, if you're expecting like a screaming deal, meaning not selling for listed price, that's not necessarily going to happen. Now, sale price to original price ratio means that there was a price reduction at some point because this is slightly lower than the previous one that we had just seen. And as far as months of inventory, I like to look at year over year because that's usually a month indicator, right? There are, higher inventory months, lower inventory months. So this is year over year. And, in 2019, we had 3 months of inventory, 2018, 2017, close to that as well. And in 2022, we still have, less than 2 months of inventory. What that means is, how quickly properties are being absorbed by the market. And generally speaking, 5 months is considered a neutral market. Having 2 months means we have low inventory. Again, just setting the right stage, like we have low inventory and we still have a strong buyer demand, even if their budget is being affected. But the key one here is price reductions, because I feel like that's the biggest piece that has increased kind of dramatically since the interest rate increase. And you can see in May and June was when all of a sudden there was like a big push where we just had not seen that previously. That was kind of like the biggest shock, in my opinion. And we've continued to have an increase. And I think what's happening is, sellers were still hoping to get these pie in the sky prices when for the first time in a long time, buyers were able to say, you know what? I'm not interested. Where buyers previously were doing anything they could to get their foot in the door. Now they're saying, actually, this is not the house that I want, and I do not want to make it the house that I'm looking for. I'm going to move on. And so they're having to correct. That's what those price reductions are indicating, in my opinion. Are you seeing a lot of contracts come through that are lower than the listed price?
Yeah, so I'm kind of seeing both right at list price or slightly lower is kind of what I'm seeing. I'm not seeing a huge amount going over or anything like that. Maybe $10,000 over here. And then for the most part, most of them are at asking price. And then for a few of them under asking price. So it's pretty stable, like you had said in your slides right there. It's pretty much at asking prices.
I mean, also as a homeowner here in Santa Cruz County, I like to know we're still having appreciation. It's just in a much healthier sense. 3% appreciation, I'll take that all day. That sounds great.
Yeah.
Owning a home, especially here in Santa Cruz County, we were talking about this earlier. Not only are we in proximity to Silicon Valley, which is a great provider of jobs, but also we have the ocean, we have the redwoods, and we have everything in between. We've already established a strong buyer pool for those specific reasons. So we kind of have our own real estate market here.
Yeah, we definitely do. I actually had a friend come visit from San Francisco, and he came out he'd never been to Santa Cruz. And he went onto my deck and he's like, "What's that noise?" And I said, "The birds?" And he said, "Yeah." I was like, "Oh my gosh." He's like, "I've never really heard that before." Story. Yeah, that's pretty terrible.
Okay, so something else I like to look at too is expired, canceled, and withdrawns, which is the market's rejected them, right? For some reason or another, they did not sell. And so I like to look at year over year to see if there's kind of an outlier in our particular situation right now, or if it's kind of the trend. And so you can see here, there's not a huge increase, we're seeing an increase for the market that we were just experiencing, but year over year, it looks relatively typical. And then here, I like to just kind of check overall stats year over year to kind of give you a big picture. The biggest change that you'll see is the price reductions, but everything else pretty much looks par for the course, except for the fact that we've appreciated so much. And this is just to indicate market health in general, how many properties are coming on the market, how many are going pending, right? Like how many buyers are ready, willing, and able to actually make the jump and buy versus how many actually close. And you can see we've got a pretty healthy market. Properties are selling, they're going into contract. And from my end, I'm seeing a steady demand of buyers. I'm doing, plenty of buyers consultations, showing plenty of houses, we're successfully writing offers and getting them accepted. And we're also being just a little bit more creative with our offers. I'm telling clients, ask for what you want, because right now you're not against 5 other buyers. So make sure that you're comfortable, and let's put you in a situation where you feel like this is a win-win. And like I said, I have a contract right now that was contingency on the sale of their property. Everything went completely fine. We were able to get them the house of their absolute dreams that they have been looking for 3 years. And it finally happened. And it's just this like wonderful situation. So I have consumers asking me all the time, what's going on in the real estate market? Is it really hard right now? And I'm just like, this is the most fun I have had in real estate in a very long time. And it's much more enjoyable to be a part of it, for sure.
Yeah. And what's the worst they can say is no. So why not try?
Exactly. I've noticed, millennial buyers, I have experienced so many times them say the exact same phrase. I don't want to offend them when I represent a buyer. And I'm just like, what are you talking about? Like, how are you going to negotiate? And that's why you should hire an excellent realtor on your side to help you in these negotiation processes. But I find that very, very interesting. You've got to be your own advocate, especially in a changing market. You've got to set yourself up for success and ask for the things that you want. And so then this is my final slide. This is just the overall trend of median sale price in Santa Cruz County. So you can see, in the 2008, 2009 downturn, yes, it went down, but ultimately we're on an upward scale. It's a great place to buy a property.
That downturn was pretty an anomaly. That was, so many people going through foreclosures that we were just in a, all created by my industry, all created by bad financial decisions on big banks lending out money to people that they shouldn't have.
Right.
And my industry created that. So I take that out of the anomaly, that I don't think we're going to see that happen again, because for the most part, these days, people can't afford the homes that they're living in right now currently.
Right. And so you also had brought up, ways for buyers to really come out on top in this changing market. And I'm really excited for them to hear about them. Can you touch on those things that you were discussing about, their credit and down payment options? Can you touch on those things?
Yeah, definitely. And I'm speaking to basically anybody that wants to buy real estate, whether it's your first time, you're upgrading your home, or you want to buy investment property for real estate. So these are all the things that I would do myself to prepare myself to buy. So number one is keeping your credit clean. Credit score is just, determines the interest rate, and being at the absolute optimum credit score, I think, is very, very important. So I downloaded the Experian app, and I kind of geeked out for like the last 6 months to kind of see where my credit score goes and what things made my credit score better. One of the things I realized is I actually asked my wife, I said, hey, she pays the bills in my family. She likes to manage all that. I said, hey, let's pay our bill 3 days before the credit card statement actually comes out. So before it's actually due, let's see what happens. She started paying it 3 days before, and our credit score actually spiked about 10 points. And I was like, oh, wow, that's actually kind of cool. Nobody's ever told me that before. It's just me messing around. Secondly is keep your credit cards at a 30% maximum. So if you have a $10,000 limit, don't charge over $3,000 on that. If
Okay.
you're going to, go to the credit card company and try to get that account increased. My
Okay.
wife wanted a points card so that we could use that to travel. So when they approved us, they only gave us an X amount of limit, and it wasn't enough because we always used the credit card. So I was like, went back to them and said, hey, I'm only taking this credit card if you bump up my line by 50% more. Oh, no, sir, we can't do that. And I said, okay, cool. Just cancel the card then. Oh, no. Hang on a second. Oh, we actually just got the approval. So sorry about that. So they'll do it. So just keep pressing at it.
Right.
Don't pay bills late. That's the absolute, that will drive down your credit score tremendously. I have people with 800 credit scores and they make one late payment on a credit card and it was for $50. And if you're $50 late or if you're $3,000 late, it's
Right.
still the same impact on a credit score. You were late.
Right.
That's going to drop that credit score. So try to keep everything on auto pay, pay things as soon as possible.
Can I chime in just for a second?
Totally. Definitely.
So
Please.
in addition to that, about like having buyers ask for what they want, when I was refinancing my house, that came up where I had a late payment from a water company that was just kind of lingering there. And I had just forgotten about it. And I could have taken the hit, which would have affected my monthly payment, which for me is my bottom line. Or I could just ask for them to forgive it, which I did. And they did. And that was the end of it. And we did a rapid rescore and it was completely fine. And I'm not saying everybody's going to forgive a late payment, but I'm just saying, in life, when a hurdle comes at you, that doesn't mean that there aren't other options. You have to just keep trying. And, being an excellent lender, you have these resources and you have these abilities to overcome these obstacles and help guide people through that.
Yeah, definitely. And like you had said, dispute some stuff. Like if anything shows up on your credit score, you can go to TransUnion, Equifax, Experian. So it's the 3 credit reporting agencies. You get a copy of your credit report each for free, 1 per year, and dispute anything on there that is showing a derogatory remark on your credit report. Even if it's something from 3 years ago and you have no paperwork in regards to it, dispute it. 70% of the time, it's going to fall off if you don't owe them any more money. So it'll just help you in the long run. So definitely do that. Don't buy a new car. I like to throw out this number real quick. A $700 car payment per month, which is almost normal these days, equates to $116,000 worth of mortgage. So if you go out and buy this car for $700 a month, you're gonna not be able to qualify for $116,000 more on a mortgage payment. So that's pretty sobering. Down payment wise, everybody asks me, what should I do about down payment? How do I put 20% down? Down payment's not required to be 20% down. You can get as low as 3%, 5% down, some situations like that. But some of the ideas that have happened lately is down payment, like some of these people who do get stock options from their or restricted stock units, instead of actually selling the stock, they can actually borrow against it. So that money is still being invested in the stock market, but they're just borrowing against it for the down payment. And they've been loving that because they're not actually having to lose that asset. Asking for gifts from family members. So definitely you can use that as your down payment. Borrowing from a 401k, I love that because interest rates are down right now as far as 401k goes, as far as how much they're paying you back. When you borrow from the 401k, you pay yourself back the interest that you're paying. So you're just paying yourself back those payments. And right now, again, that it's not creating very much interest, it's a great place to borrow from. Next is about income. I've had a lot of conversations of, I'm pretty blunt when it comes to what is it that you have to do, because my world is numbers, where numbers are finite. It is what it is. I've told so many clients, hey, you actually need to make X amount of dollars to buy here in Santa Cruz. So here's my card, go to your boss, tell your boss, in order to buy in Santa Cruz and stay in here, I need to make X amount of dollars. So I've actually had a few great feedback that people got raises because of that, blaming it on me, that they need to make a little bit more money. So I tell them to go do that. I've even had people, I had a transaction not too long ago where 2 best friends bought together. There was 2 houses on one lot. They brought their finances together and they were like, hey, why don't we go in and buy this property together? They didn't have spouses, significant others. And so they're like, hey, let's combine our buying power. We can buy something better. And They're
Wow.
ecstatic. We closed last month and they're able to buy together. I have that exact situation right now where 4 people are coming together to buy this one property. So I'm
Wow.
seeing that more and more. My idea on that is have your prenuptial set up. So have your exit strategy just in case. But
Yeah.
when a single person can't do it, there is other ways of possibly doing it.
Right.
I've even had some clients go and talk to their parents and, hey, can you help me buy this property and we'll co-sign and we'll own this house together. And then I'll go out and rent out rooms so I can help make the payment. So,
Right.
that is a great way. Here in Santa Cruz, it's hard to find places to live, and it's in such demand that if somebody can buy in and have 2 or 3 extra rooms and be able to rent those out, it's a great way of being able to afford a property here in Santa Cruz because things are expensive.
Right. Right.
Um,
I'd say the majority of people that I work with, unless they're selling another property, they're usually getting some type of funds from their parent. I would say it happens more often than it doesn't.
yeah, exactly. And I think in our society, as a parent, I'd always love to help out my kids wherever I can. So yeah, it happens quite often.
Right.
Um, I've actually had quite a handful of people who have inherited IRAs. So either, I had one where their uncle passed away and inherited an IRA from the uncle. Well, on that IRA, when it's inherited, even though you're not of retirement age, I can take that IRA balance and divide it by 36 months, and I can actually use that as income. She didn't know that she could do that. So it had her qualify for a way bigger property or more expensive property. And her plan was to rent out rooms. So she knew she would be able to make the payment. But
Right.
on inherited IRAs, you can actually use that money as income in order to qualify.
Wow.
So pretty cool.
Yeah.
Just earlier this year, they changed that you can actually use rent from the accessory dwelling unit on a property. You can use those
Perfect.
rents to qualify now. That's pretty cool. So they're doing some things, and Santa Cruz is filled with
Yep.
accessory dwelling units everywhere. So that
Right.
has helped out clients big time. And then there's this actually a Netflix series, or it's a documentary. It's called Get Smart with Money right now. And it was actually really cool. I watched it about a week ago, and it was just real world things that you can do today in order to limit your bills going out or save a little bit more money. It was really down to earth, and I suggest to my clients definitely watch it. It's even easy for kids to watch. So I've had my kids watch it too, and it was actually a really good series if you have a chance to watch it.
And it's Get Smart with Money.
Get Smart with Money, exactly.
Cool.
Yeah. And then also just bills. Like I had said, don't buy any new cars. If you do, take the longest. I understand you have to sometimes. I had to starting out in life. I had to take a car loan because I didn't have the money to pay cash for it. But take out the longest length of loan possible, so it keeps your payments down as low as possible. That's your
Okay.
minimum payment, because that's what we're going to qualify off of. If
Right.
you take a 6-year loan but make payments based off of 3 years, I'm still going to take the 6-year loan payment as your minimum qualifying payment. I
Right.
don't have to use the 3-year. So some people are like, I want to pay it off quicker because the interest rate's lower. It could hurt you in the long run.
Right.
Same thing with a 30-year versus a 15-year loan. A 15-year, the payment is so much more greater that it's stopping you from buying the next property. I looked at a payment yesterday between a 30-year and a 15-year was $1,700 difference. That $1,700 difference represented $283,000 in less buying power. So
Wow.
somebody who they were in a situation where their current residence, they had a 15-year, they wanted to buy a new property without selling their house first. Well, because they took that 15-year, it was stopping them from borrowing $283,000 more. So
Wow.
that's just the 15-year versus the 30-year where it can be detrimental.
Right.
Last thing is, if you're a homeowner now, I'm a huge fan of home equity lines of credit. Home equity lines of credit, they usually are no cost, and you don't pay on that money unless you borrow the money. So I love them for emergency purposes. Like,
Right.
for example, when the coronavirus hit and they basically sent us all home on March 20th or something like that, whatever the day it was, I called my wife. I said, hey, let's pull off the $250,000 off our equity line. I have no idea what this means. We may have to pull up the family and move to New Zealand. So we took that money, deposit all into our savings account. Yes, I paid interest on it for 2 months, but I slept well at night knowing that
Yeah.
we had this extra fund in there. Home equity lines of credit can be used for down payment on the next property. There's just so much more accessibility if you were to have it. I had a client the other day call me and she wanted to do a home equity line. And she said, I just want, something small, just a $50,000 home equity line. And I was like, you know what? My recommendation is take the biggest amount you can get. You could take a $300,000 equity line just in case something comes up. If your house burns down, then you could just write a check off that equity line to get it rebuilt. If, all of a sudden unexpected bills come up, you have the ability. So I encourage my clients to go get home equity lines. And you always want to borrow money when you don't need it. That's like one of the things is borrow it when you don't need it, because when you need it, it's going to cost you more. So, I've had clients say, I just lost my job. Can I get a home equity line? Nope, you can't, because you lost your job. Now you can't do it. But if you had done it before, obviously I'm not going to rub it in, but if you would have done it before, you have it set up, they couldn't pull the equity line because you're no longer employed. So borrow money when you don't need it. I'd say those are probably my main things to pay attention to get yourself set up to be buying the next property.
Wow. Okay. Well, it sounds like you have a lot of great ideas for buyers that are looking to buy. What is the best way for a buyer to get in contact with you if they have further questions?
So best way is on my cell phone number, which is 831-818-2339. I am one of the people that when I call Verizon, I want to talk to them right then and there. I don't want them to, get on the line and call me 12 hours later. So I work the same way with my own clients. I don't care if it's Sunday evening, it's 5 o'clock. I don't care if it's 9 o'clock. Call me. If I'm awake, I'll answer. I'll work when you work.
That's awesome. And I can attest to that as well. You are the best lender here in Santa Cruz County, and I'm sure the greater Bear Area as well. So this has been wonderful. Thank you so much for all of this information. I am going to end our webinar here, but I can't thank you enough. I hope we can do this again real soon.
Cool. Awesome, Kaelin. Love working with you. Thank you for having me. I appreciate it.
Okay. Have a good one.
You too. Thanks.
Bye.